Wow, what a day! The market just gave us all some serious whiplash, right? I mean, one minute we're popping the champagne for Dow 40,000, and the next, it feels like the floor just completely dropped out from under us. If you're sitting there tonight, scratching your head wondering, what on earth just happened? You are not alone. So let's break this down, let's look at the tape, and figure out what it all means for our game plan tomorrow.
So here's the big question on everyone's mind. How did we go from celebrating this massive milestone just a few days ago to, well, to this sea of red today? The rally was absolutely firing on all cylinders, and then, poof, it just vanished. So what gives?
You know, it was a classic tale of two tapes. What we're going to do right now is unpack the two huge stories that really drove this reversal. And the first one? It's a blockbuster jobs report that completely changed the entire game.
All right, first up, what I'm calling the good news freakout. And I know, it sounds totally crazy, but today what was great news for the American economy was actually terrible news for the stock market. And it all boiled down to one thing, that jobs report this morning.
So the January jobs report comes out, and it was an absolute monster. The economy added 353,000 jobs. Now, on any normal day, you'd think, hey, that's fantastic. But in this market, it was a total shock. And to really get why, you have to look at what Wall Street was actually expecting.
You see, the street was only looking for about 180,000 jobs. We didn't just beat that number, we blew it out of the water. We almost doubled it. And that, my friends, set off a chain reaction that every single trader needs to understand. It's this weird paradox we call good news is bad news. The market saw that scorching hot jobs number and instantly thought one thing: inflation. See, a super strong labor market means more people have jobs, they make more money, and they spend more, which could keep inflation kind of sticky. For all the investors who are betting big on the Federal Reserve to start cutting interest rates soon, this report was like a giant bucket of ice water to the face. It basically dismantled any hope for a rate cut this spring. And that brings us to the second major story of the day. On top of all those rate fears, there was this absolutely brutal sorting happening inside the hottest sector on the planet, AI. I mean, for months, AI has been the engine driving this whole market. But today, we saw exactly how that engine can be a double-edged sword, creating these huge winners and some massive, massive losers. Just look at these two stocks right here. They perfectly capture the two faces of AI today. You've got AppLovin, which, by the way, posted a killer quarter with revenue up 66%. But the stock gets absolutely hammered, down 18% because traders are suddenly worried that new AI tools are going to disrupt its entire ad business. And then you've got SanDisk, which surged over 5% because the AI boom needs a staggering amount of their memory chips. It's the same theme, but with polar opposite results. And this is where that ripple effect really kicks in. This insane, off-the-charts demand for AI chips is causing a global memory shortage. Now that's great for a company like SanDisk, but it's absolutely crushing other hardware companies like Cisco, who saw their stock drop today because those higher component costs are eating right into their profits. So you've got these two huge fears hitting all at once: higher rates and this AI shakeout, and it's forcing a massive shift in the market.
What we're witnessing right now might just be the beginning of what we call a great rotation. You've got big money fleeing the high-growth, high-risk tech stocks that have dominated for years, and they are scrambling to find shelter in safer, more defensive parts of the market.
Just look at this chart. Year to date, the tech sector is down over 4%. Meanwhile, consumer staples, the toothpaste and toilet paper stocks, they're up almost 12%. That is a huge, huge divergence, and it tells you exactly where the fear is right now.
And listen, this isn't just some minor shift. According to Bank of America, money is flowing into the consumer staples sector at the fastest pace ever recorded. This is a historic flight to safety. So the crucial question is, who's actually winning in all this?
Well, the money is flowing into the names you know, the household names. Giants like Walmart and Costco are getting a lot of love right now, and so are classic defensive plays like Procter & Gamble, Coke, and McDonald's. In a nervous market like this one, their stability and their dividends start to look really, really attractive.
Okay, so after a messy, confusing day like today, what's our game plan? How do we cut through all this noise and focus on what actually matters for tomorrow's open? Believe it or not, it all comes down to one single number. Forget the headlines, forget the talking heads on TV. If you want to know where this market is headed next, this is the only indicator you need to be watching.
It's the 10-year Treasury yield. After today's jobs report, the yield on the 10-year note just surged to its highest level of the year. This is the market's way of pricing in a higher-for-longer interest rate world.
As long as this number is climbing, those high-growth tech stocks that we all love are going to remain under pressure. It's the single most important barometer of market fear right now.
Period. Which, of course, leaves us with the ultimate question as we head into tomorrow. Was today's big sell-off just a one-day panic? A quick digestion of a hot jobs report? Or are we seeing the first real shots fired in a whole new game, one where safety trumps growth and the old market leaders get left behind? Stay sharp out there.